Hi everybody, welcome back to the channel. Today we're talking about the Schwab US Dividend Equity ETF. This ETF, or exchange traded fund, is one of my favorites actually. And I think in terms of quality of ETFs out there, overall, if you're looking for an ETF that pays consistent dividends and you believe that this ETF can be part of your long-term portfolio, I think SCHD, Schwab US Dividend Equity ETF, is one of the best ones out there. And when we're looking at making income from this ETF, we can first take a look at the dividend. And if you have a yield of 0.0387%, you have, let's say, a hypothetical $500,000 portfolio in retirement. Now, that seems far-fetched, right? You have a $500,000 portfolio. But the fact is, guys, with inflation, that's not so far-fetched, right? I mean, like long-term, building a portfolio of $500,000 to $1 million is not going to be far-fetched for a lot of people going forward, I think. And, the idea is we want to take the money we have and earn whatever we can in terms of dividends, but also take a look at things like the wheel strategy, right? So if we have the wheel strategy, we're looking at additional income we can earn, not just from the dividend itself, but also from, let's say, cash secured puts and covered calls, which we're going to get into in this video. But if you like this type of content, thank you so much for tuning in. My name is Drew. We talk all about cash flow dividends on this channel. We talk all about how you can make income from your portfolio, of course, in the context of your own risk tolerance, your own investing goals. Always consider those things when you're looking at any of these investments. But right now, we're going to have some fun and take a look at a hypothetical $500,000 portfolio invested strictly into SCHD. And this portfolio is going to be invested, this yield right here is 0.0387%. So we're going to take that, multiply it by our $500,000 portfolio. And specifically, we're going to target 18,500 shares. I'll explain why that exact amount. It's closest to 500,000 to be simple, but basically, it has to do with the options we're trading. So 18,500 shares is our position. We're going to be purchasing these shares at $27 per share. Now, right now, the ETF is actually trading at $27.45, but we are going to be entering into a cash secured put trade with the Schwab US Dividend Equity ETF in this video. So when we look at the long-term performance or the longer term over the last several months, if you want to consider that long-term, we do have this right here going from 29 to 27, 25 at the bottom, down here in May. $25 was kind of the floor there in 2024. Now we're going into 2025, so we'll see how this ETF does. But you see there's kind of a range between, let's say, $25 and $29 per share that has been pretty consistent with this ETF. And when we come over here to the Schwab US Dividend Equity ETF, we can look at the total expense ratio. First of all, that's a great cost. And what we're seeking here is the total return of the Dow Jones US Dividend 100 Index. So it's basically a straightforward low-cost fund that offers potential tax efficiency. It can serve as part of the core or a complement in a diversified portfolio. So you could take, let's say, a $500,000 core portfolio and put it into SCHD. Now, as of October 10th, 2024, keep in mind this one did do a 3-for-1 share split. So basically, it was a forward split. So post-split, right, basically you get more shares at a lower price. And the dividend and everything else kind of equals out. So it basically just, lowers the amount of dividends you receive, but you also have 3 times the amount of shares, if that makes sense. So the share price goes down by a factor of 3. But you get 3 times the number of shares. So they did do a forward split, 3-for-1. But it goes over the highlights of this fund, what it's investing in and everything. Tracks an index focused on the quality and sustainability of dividends. That's the focus, quality and sustainability. If you look at the dividend history for this ETF, you can see that the dividends have gone up since 2018, for example. 40 cents, now they're paying 70 to 80 cents, 60 cents. So these dividends have gone up, especially since like 2013, 2014, 25 cents, 35 cents in 2017, 40 cents, 50, 60, 70, hitting 80 now. So you see that these dividends have been increasing, right? So now the question is, when we have this split, what happens to the dividends post-split, right? The dividends are expected to go down. But nonetheless, we have had increasing dividends as you've seen over the last several years. But it's just a matter of looking at the companies it's investing in. So you can take a look also at which companies is this ETF investing in. Could this be a good diversified ETF for retirement? Could you take a large portfolio and put this in there? I think the answer is yes, right? And how much income could you actually make from this ETF, right? Per year, not just with dividends, but also if we kind of implement the wheel strategy along with trying to collect those dividends. So if you look at the portfolio right now, we have some of the top companies in the world. We have Pfizer, we have Abbey, Coca-Cola, Cisco, BlackRock, Bristol Myers, Texas Instruments, PepsiCo, Verizon, Lockheed Martin. You have asset allocation in different sectors, well diversified. 99.92% stocks, though. That is something to keep in mind if you're looking at different types of cash flowing investments, maybe some bonds mixed in there. But this is invested in stocks. If you look at, you can look at the prospectus and other regulatory documents on the website. So it has a lot of details. But the one thing I love about this is the diversification, also the low fees, and not a bad dividend yield. Not a bad dividend yield of 3.87%. And as we've seen over the last several years, the dividends have gone up in value. So if we take 3.87%, and let's say we multiply it times the amount we're going to be investing, which is going to be $499,500, because we're buying 18,500 shares at $27 a share to start off with. We're going to be basically getting $499,500 invested at the yield of 0.0387. That's going to be $19,330 per year. Okay, that we're going to be earning just in dividends on this basically $500,000 portfolio. So assuming we do nothing else but hold the ETF, we're going to be earning $19,000. Now that may not seem like a lot. If we take that divided by 12, it's about $1,600 per month. So especially with inflation, right, you may be thinking there's no way we can live off this, especially on a $500,000 portfolio. Take additionally this strategy we call the wheel. And the first step in this process is to get paid to buy the security. Now, I'm assuming that you just probably are investing a lump sum, right? This is one thing to keep in mind. Let's say you're investing a lump sum of $500,000. You've liquidated every other investment. You're ready to go into retirement. We're just having fun, keep in mind. Obviously, your own risk tolerance, your own investing goals. But $500,000 into the Schwab US Dividend Equity ETF. We're going to take that all at once, and we're going to buy basically 18,500 shares. So that's 185 contracts, put option contracts. Now, these put option contracts have a strike price of $27 per share. So the first step in the wheel strategy is to sell a put, or basically to get paid to buy stock or buy an ETF. Now, this expiration is January 17th, 2025. This basically means we are on the hook to buy 18,500 shares. Remember this number, $499,500 worth at 27 is 18,500 shares. We're basically on the hook to buy 18,500 shares at $27 per share up until January 17th, 2025. Now, if we look at the limit price of what we're going to be receiving, this is the cash that goes into our account, including after commissions, right? So, sorry, just dropped something on the ground. After commissions, we have $1,757.57 going into our account. So we can also take a look at different strikes here. If we want to take a little bit more risk in terms of that strike price, we can earn up to 15 cents. Now we're getting $2,654.75. So the idea is with the wheel strategy, if we end up getting long, if this goes below, let's say 27 or 27.33, whatever strike price we choose by January 17th, 2025, what can happen is we may be forced to buy and put, the collateral we're putting up for this trade is going to be basically the $500,000, the 18,500 shares that we're willing to buy at $27. But if you think about it, the current price is $27.44, 45 cents basically. If we look at buying this at $27, we're actually getting a discount. Now, the expiration is January 17th, 2025. Assuming worst case, this finishes at, let's say, $26.50 or $26. we get long at 27. Now we can immediately turn around and sell a covered call. So it's constantly trying to earn income. And if we take a look at, let's say now let's just do the $28 strike. Okay, you're only getting 5 cents for this, but let's take a look at, the $27 one again. Let's kind of do this in rotation, or even the one a little bit out of the money here. If we look at 27.67, you're back to 10 cents. So, if you go back to 27.33, you take a look at that right there. And it's basically slightly in the money, right? But you can kind of get a feel. I mean, that's $6,000. So even if the call option goes slightly in the money at that point, that's the beauty of the wheel strategy too, is the options prices can fluctuate wildly sometimes, especially when they're even a little bit in the money. So if you're doing a call option and you're willing to just break even on your shares, and you want to sell a call option and collect $6,000. Now this is only January 17th. Today's January 2nd. 15 days out to expiration. Take this out of the money a little bit. Go back up to 27.67 on the call side. Take this also out, another month or so. In fact, the next dividend, if we look at timing this with the next dividend, that's something else to consider here. Look at the last dividend. They pay every 3 months. Okay, so if we can think about March or April, if we send this out to April 17th, and we do a long dated, trade here on the call side, and we basically say we want to, basically hope and pray that even if this goes in the money for the buyer of the call option, that they're not going to exercise. And in that case, what happens is, and this is true, a lot of times it's random, right? So you might not get an exercise notice up until the expiration day if it's in the money. And so you might have all this time to basically still hold on to your shares and still have the right of collecting the next dividend, which if we look at the next X day, we can expect that in March. So up until March, let's say you choose the 27.67 strike or even the $28 strike out until April. Now you're getting 50 cents. Now you're getting $9,000 deposited, as a nice paycheck into your account after your commissions and fees and everything. So $9,000 plus, whatever other dividends you're making, which we already know the dividends you're making are $1,600 a month. So we basically just add all these call and put premiums into additionally what we're making on the dividends. And we basically are betting that with this strategy, like I said, April 17th, a lot of times what will happen is there's not going to be an exercise notice. You're just going to basically be holding your shares up until the expiration day. And if it's in the money on expiration day, then what will happen is your shares will get called away on the call side. And on the put side, you'll be forced to buy your, at let's say the strike price of 27, which we're doing, which is slightly out of the money in this case. But take this also out, if you wanted to do this up till February 21st on the put side as we're getting long, you could do it at 25 cents and collect $4,500 just like that. So you can really see how even doing this like 10 times a year, doing a trade like this on the call or put side, the wheel strategy with this ETF. And one other thing to keep in mind when you're doing this is that this ETF is not so volatile. In fact, this beta is less than the S&P 500. So that means we're less volatile than the S&P 500. Now, I'm kind of getting really deep into this, but basically what we're looking at is an ETF that, if you think about a range of $25 to $29, what's your risk profile if you end up getting long on the put side, you buy your shares and then it goes down afterwards, right? So what's your risk? And I think your risk is that you have some volatility, but it's not as bad as like doing even SPY options because it's less volatile than the S&P 500 overall, and you have the ability to earn a higher yield at 3.87%. So the goal is just to continually collect premiums in rotation while trying to time out your expirations with the upcoming dividend, because a lot of times what will happen is you're not actually going to get called away your shares. If you already own the shares, for example, that's in terms of being in the middle of the wheel strategy after selling puts, getting long after a price dip, and then basically selling a 3-month out call option past the next expected ex-dividend day, and of course the payment day as well. So you can collect the dividend, and then also, worst case, your shares get called away at the strike price after the dividend has been paid. I hope this all makes sense. So that's kind of what we're going for here. Now, if you're looking at a $500,000 portfolio, like I said, we're looking at $27 if we were to do like a put trade to enter, a huge position like that right away. Maybe you already own a lot of shares in this ETF. Maybe you already have a six-figure position in this ETF, which is fantastic. The thing about it is you're not just investing in a single stock, you're investing in a wide variety of stocks. So you can really, leverage the options in addition to the dividends to earn even more cash flow if you want to. Okay, so that's kind of the whole goal of this. And of course, there's volatility risk with any ETF with this strategy. But that's just kind of what we're looking for. This is a lower volatility ETF than the overall market. We're focused on the Dow Jones US Dividend 100 Index. We're focused on high quality companies, investing for fundamental strength relative to their peers. We're getting a nice solid dividend of almost 4% on a $500,000 portfolio. That's nearly $20,000 in dividends alone on top of the wheel strategy income. And we're focused on tracking an index that's focused on both the quality and sustainability of dividends. So you really cannot go wrong with this ETF, in my opinion. I think there's a lot of potential here. The low cost, the low fees, but this is not a recommendation. This is just an example. And we had some fun today considering a $500,000 portfolio, how much you might be able to make from both dividends and on top of the wheel strategy if you were to try to combine all of those while timing out your expirations and everything else. So let me know what you guys think in the comments down below. Thank you so much for tuning into this video. God bless you all. Happy New Year, by the way, to all of you guys out there. And we will see you in the next one. Take care.